We shall commence this module by discussing about the models of trade in brief. In all the methods of trade studied till now, we have assumed that the factors of production, namely labor and capital, are immobile across nations. Labor and capital can be substituted in the production of one good from another, but they cannot be moved across nations. In fact, the HO model was based on this difference in factor endowments among nations. If movement of factors would have been allowed, then labor and capital would have migrated to the countries where they can earn higher returns, and the HO pattern of trade would not have existed. Till now, we have seen trade in commodities is one way in which factors can be traded internationally. But in this module, we will try to see the effects of direct movement of capital between nations and what are the cost and benefit attached to it. After studying this module, you shall be able to know how capital moves across the countries, learn the different forms of foreign investment, identify the issues with MNCs, examine the effect of international flow of capital, analyze the cost and benefit of international flow of capital. Let us now move on to discuss the international movement of capital. The assumption that factors of production do not move across nations does not hold true in the real world. In reality, factors do move across the nations. They both cross borders in search of higher returns. In this way, if we block their way to them, these resources will not be utilized in their maximum efficient manner. Factors mobility will increase efficiency and output as resource will now be utilized in the most productive use. However, international factor mobility might tend to equalize returns across nations for factors of production, but that does not happen as all resources are not of homogeneous quality. Types of international capital, FDI and portfolio investment. Foreign direct investment. Foreign direct investment means the international capital flows in which a firm of one country creates a subsidiary by buying a new company or expands its existing firm operations in another country. It is defined as cross-border investment in which an entity becomes a resident economy in another economy with the aim of obtaining a lasting interest and control. FDI can take through mergers and acquisitions, building new facilities, reinvesting profits earned from overseas operations and intra-company loans. The special feature of this type of foreign investment is that it also brings with managerial control, which other types of investment do not. This type of investment helps the investors to acquire an effective voice in management of the firm. It generally takes the form of acquiring a stake in an existing enterprise in the foreign country or starting a subsidiary to expand the operations of an existing enterprise of that country. FDI facilitates the transfer of technology, know-how, skills and expertise between countries and also helps to create long-lasting links between the economies. FDI can be carried by individuals as well as enterprises. Because FDI cannot be easily liquidated, therefore it is governed by a number of considerations like economic prospects, trade policy, market size, functioning and efficiency of local markets, human capital, restrictions on repatriations of earning, etc. FDI has always been linked to the improvement in economic growth and development in the host countries, which has led to the evolution of global competition to attract FDI. Many countries are now furnishing a wide spectrum of incentives to the foreign investors like tariff concessions, tax holidays, R&D support, infrastructure improvements, financial subsidies, low tax rates, etc. FDI is further classified into three types. First is horizontal FDI. These are those investments in which parent company duplicates its activities in another nation. Second is the platform FDI, which comprises of those investments which are from a source country to get into a destination country for the purpose of exporting to a third country. Third is the vertical FDI, which comprise of those investments in which firm performs different operations at different stages of production into different countries. Foreign investment was introduced in 1991 under the Foreign Exchange Management Act, popularly known as FEMA, F-E-M-A. Since then, India has liberalized its regulations to a major extent. FDI inflows in the country has improved, but due to the 2008 macroeconomic crisis, the FDI inflows have slowed down a bit. Portfolio investment. Portfolio investments are investments in the financial securities like bonds denominated in the national currency. It does not involve any managerial control such as in case of FDI. Portfolio investments include a wide range of asset classes like stocks, government bonds, corporate bonds, treasury bills, real estate investment trust, exchange traded funds, mutual funds, certificates of deposits, and so on. Portfolio investments can also include options, warrants, and other derivatives such as futures and physical investments like commodities, real estate, land, and timber. Foreign portfolio investment involves investment in foreign financial assets like stocks, bonds, commodities, etc. This type of investment is not made with the intention of acquiring a controlling interest in the issuing company. Typically, this type of investment is short-term in nature and it is made to take advantage of favorable changes in exchange rates or to earn short-term profits on interest rate differences. It provides the investor with an opportunity to diversify their portfolios and better manage the associated risk. Foreign portfolio investment can also help to strengthen the domestic capital markets by enhancing the liquidity and can also contribute to improving their functioning. This in turn will lead to optimal allocation of capital and resources in the domestic economy. For an emerging economy, foreign portfolio investment can prove to be a significant contributor to its development, creating a significant wealth. Foreign portfolio investment is also referred as the hot money because of its tendency to move in and out of the markets really fast. Foreign portfolio investment brings in instant money which helps in rapid development and creates new jobs and opportunities. But in case of downturn, it is these investments which flow out quickly and hence create volatility. The investing class under FPI is classified as foreign institutional investors known as FII and qualified foreign investors known as QFIs. Example of FPI. Mr. ABC, an American citizen, purchases 100 shares of stock in a company based in India. ABC now owns part of an Indian corporation, the shares of which are part of his personal investment portfolio. ABC is eligible to receive dividend payments and can participate in shareholder decisions or sell the stock of a profit or loss. ABC's share is very minor and his chief concern is not on long-term profitability of the company but the short-term value of his stock. He might therefore sell his share quickly if the share prices goes up or down significantly. Example of FDI. Let's assume company X in US has a lot of cash and decides to take some of that money and purchase a company Y in India. Company X, a foreign investor, now owns an Indian subsidiary company. Unlike ABC's small investment, this is substantial and more likely to be long term. Company X might not just sell the company in case of downturn and take steps to revive it. Now we will discuss the motives for FDIs and portfolio investment. International investment is important to most economies and can be particularly vital for developing countries. Foreign investment provides essential capital to help spark the creation of productive enterprises. The basic motivation for FDI and portfolio investment is to earn higher returns and to diversify financial portfolios. A well-known principle of risk diversification is that combinations of assets will often outperform single asset if the return on individual asset do not move together. If returns are negatively related, then diversification benefits can be considerable. And we all know that foreign investment provides essential capital to help spark the creation of productive enterprises. Let us now discuss the capital flows and multinational corporations, popularly known as MNCs. The movement of capital and labor between countries is being facilitated by the MNCs. MNCs are responsible for much of the cross-border flows of capital. An MNC operates in a number of countries in the form of subsidiary or affiliates of the parent company. The parent company provides managerial and technical expertise to its affiliates and also share a part of their earnings. MNCs now represent the most visible form of globalization. Top MNCs in India includes the name of IBM, Microsoft, Nokia, Ranbaxy, Reebok, Sony, Tata Motors, etc. So MNCs are diversified into almost every field. It is because of the MNC that one can find his favorite McDonald's burger and Coke in India as well as US or in some other country. In simple word, MNC involves international relocation of production. International relocation of production may be understood with respect to production in the context of a domestic economy. Ordinarily, a firm undertakes a productive economic activity by employing factors of production like labor and capital, which are sourced from within the economy. The product is also produced and normally consumed within the economy. The organizational structure is unitary based because the firm consists only of a single unit, and if at all there are any branches or subsidiaries, they also operate within the limits of national boundary. International relocation of production therefore is a process in which firms belong to one country goes abroad and invest in that country and employs the factor of production of that country, essentially with the help of investment that is emanating from the domestic firm. It also ordinarily implies that such a firm employs its own technology. So, the basis of international production lies in investment and technology. The other factors are ordinarily sourced from the country where the production unit is relocated. MNCs are becoming an important part in global economic activity. The share of foreign affiliates has been rising in all parameters, indicating the growing importance of MNCs in global economy. There are reasons for the existence of MNCs. Let us discuss them now. As per Buckley and Kazan in 2009, many of the multinational operates in different countries because of the various different reasons such as low labor cost, serving a huge market, cutting of their taxes and production cost, innovation in technology and exploitation of resources. But the basic reason for the existence of MNC is the competitive advantage of a global network of production and distribution. This comparative advantage arises in part from vertical and horizontal integration with foreign affiliates. Thus, MNCs find it beneficial to be integrated with other countries either horizontally or vertically. By doing this, they are able to reduce their cost significantly and provide goods at competitive prices. Also, having affiliates or subsidiaries around the world helps them sharing the information and helps them in making meaningful decisions in coordination with the changing conditions around the world. MNCs sometimes set up their affiliates just to take advantage of lower taxes in some nations. Sometimes MNCs feel that it is necessary to maintain control over the production and operations of their product or the service, and thus they decide to set up a subsidiary of their own firm rather than investing in another firm. All these reasons give MNCs a competitive advantage, and thus they set up their subsidiary companies in other nations. To summarize in brief, we can say that MNCs have risen to exploit the competitive advantages associated with increasing the size of the firm. These advantages include the monopoly power that may come with horizontal integration, the control of inputs that comes with the vertical integration, the ability to exploit economies of scale in distribution, production and information, the flexibility to locate R&D production and distribution facilities in nations best suited for those activities. Size also brings significant bargaining power in both the economic and political spheres. Now we shall move on to discuss the issues with MNCs in source country and the host country. MNCs have also attracted a lot of debate regarding its setup and operations in both the host country and the source country. It involves various economic and non-economic, political and cultural factors. There are both cost and benefit of attracting MNCs into a country. Issues with the source country. MNCs lead to loss of jobs in the home country. Many corporations set up their plants abroad which could have been built in their home country. Thus, this leads to an export of jobs, leaving domestic workers dissatisfied. Not only MNCs involve an export of jobs, but also an export of advanced technology which could have been used to maximize the utilization of resources in the home country itself. The practice of transfer pricing, that is charging higher input prices to their affiliates in high tax nations so that they earn lower profits and pay lower taxes, grind down the tax base of the country. MNCs may lead to confiscation of assets and the compensation paid may not be appropriate. Issues with the host countries. MNCs bring with it advanced technology which sometimes may not be suitable for an economy which is labor intensive. This will worsen the situation as industries work on machines and require less labor. MNC get to use the skills and entrepreneurial talent of domestic workers in their firms which could have been very well employed in the development of own nation. The practice of transfer pricing distorts the tax base of the host country as well. MNC's impact on development is very uneven. In many situations, an MNC activities reinforce dualistic economic structure and widen the income inequalities. They tend to promote the interest of some few modern sector workers only. MNCs may damage the host country by suppressing the domestic entrepreneurship through their superior knowledge, worldwide contracts, and advertising skills. They drive out the local competitors and inhibit the emergence of small scale enterprises. Moving on to discuss the role of MNCs in developing countries. MNCs, despite the above mentioned issues, provide a range of benefits. This is the reason developing countries and underdeveloped countries provide a range of incentives like tax breaks, investment credits, etc. to attract the MNCs and their investments. MNCs help increase investment, employment, output and hence export of the host country. MNC help develop skills and promote the talent in the host country. MNC make the market more competitive and incentivize the nations to develop. MNCs bring the ideas and help in exchange of the cultural values. By improving the exports of the host country, MNCs help in improving the balance of payment status of a country. MNCs help promote globalizations even more by integrating the markets of so many economies altogether. MNCs plays the role in filling the resource gap between the desired investment and the domestically mobilized savings. Thus, we can say that the MNCs do create rigorous employment opportunities in the country, have fostered towards the reduction of poverty and dependency, although much of the gains are again lost through transfer pricing to the main branches of this MNCs in the developed countries. The corporation has substantially reduced the poverty levels mainly by the creation of employment opportunities to the locals and also substantially by their schemes of contribution to the poor that they reveal is ideal and active. We can thus conclude that the government should take a prerogative role in supporting the operation of MNCs since they have boosted the economic development of the developing countries with a drive towards full employment. However, the over-dependence on these MNCs should be avoided at all cost. Now, we will summarize what we have discussed in this module. The capital moves across countries in mainly two forms, FDI and portfolio investment. FDI refers to an investment made to acquire interest in enterprises operating outside the own economy. Portfolio investments are the investments in the financial securities like stocks, government bonds, corporate bonds, treasury bills, real estate investment trust, exchange traded funds, etc. International flow of capital occurs for a number of reasons: investment, job expansion, profits, etc. The basic motivation for FDI and portfolio investment is to earn higher returns, possibly resulting from higher growth rates abroad, more favorable tax rates, or greater availability of infrastructure, and to diversify the financial portfolios. MNC is a firm that carries its operations around the world. MNCs are considered to be an important vehicle for carrying capital flows from one country to another, and they have grown to be most prominent in the world. MNCs have risen to exploit the competitive advantages associated with increasing the size of the firm. There are various issues with MNCs in both resource and host country concerning mainly tax and employment. Despite all these issues, MNCs provide a variety of benefits which compensate the problems faced to a large extent. The government should take a prerogative role in supporting the operations of the MNCs, since they have boosted the economic development of the developing countries with a drive towards full employment.